Welcome to SmithWeekly Discussions, an occasional program for our members of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position along with your favorite beverage to enjoy the discussion. We remind our audience to examine our show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience of Smith Weekly, including Sean M., Paula C., Michael G., and Gordon S. On the program today is a returning guest. Mr. Scott Melbye has joined us. Scott is the president and CEO of Uranium Royalty Corp, a pure-play uranium financing house that utilizes royalty and stream finance to assist developers and producers in the uranium sector. Uranium Royalty is listed on the NASDAQ under the symbol UROY, as well as on the Toronto Stock Exchange under the symbol URC. Scott, thanks for coming back to talk to us. How you doing?
I'm great, Andrew. It's always good to be on your program and good to catch up. Lots of things to talk about. Very exciting times.
Yes, it's been a while, Scott, since we've had you formally on the program, and appreciate you coming back to chat with us briefly and talk a little bit about URC and a few other things. But how about we kick this one off with just you covering off the key issues in your mind, Scott, really how you see the uranium sector at this point. We're July 2023 here, and really your outlook for the sector, say, for the rest of the year.
Sure. Well, it's there's a lot of milestones here. August of 2023, next month, I reach my 40-year mark in the uranium and nuclear energy industry, and so it's provided me a lot of perspective through the years to see how our industry has grown and progressed over this period. But I have to say, looking at really three areas. I mean, clearly the megatrend towards green energy and I would say failure of the green energy transition has really caused both political left, political right, industrialists, environmentalists, all to really embrace nuclear power. And I see that firsthand in my activities on Capitol Hill as part of the Uranium Producers of America. The supply and demand fundamentals right now have gone through previous cycles like the 2007 bull market, and I see the fundamentals that are coming together today are better than I've ever seen in 40 years. I mean, you have a structural gap of 40, 50, 60 million pounds annually of production to consumption. The production discipline that kicked in 2017 is really continued in earnest and has had the impact of rebalancing the market, only to have Sprott and other investor vehicles like Zuri Invest and even just companies like UEC and URC buying uranium off the spot market, which, if there was any rebalancing left to be done, that clearly vacuumed up remaining excess inventories off the market. So, honestly, as we sit here in July of 2023, we are in a rebalanced uranium market, and I use the past tense. Doesn't mean there aren't still sort of churn volumes in the spot market that churn and create the daily volume in that market, but you've really gotten to the point where the big overhang of secondary and inventory supplies are gone, and now going forward is very much going to need to be a production-driven market. So price formation will be determined by cost of production, availability of production, ramp up of new mines, restart of old mines. And it really, it means the uranium market is kind of maturing and becoming more like, established commodities like copper, silver, gold. But one thing that we don't have in this market that other commodities do is we don't have a lot of standby mine capacity or mines that are in ready startup phase that can meet that demand. There are a number of them, and URC is invested in some of them and wants to invest in more of those. But I think we're going into a period of supply shock. I don't mean just tightening, supply shock in 2024, 25, 26. So the fundamentals, again, have never looked better. And then the third leg of the stool is really geopolitical. I think this would be an exciting story without the developments in Ukraine and Russia. But I mean, that has really caused Western uranium consumers to really look to uranium supplies that aren't under the control or influence of Russia and, frankly, I think China going forward. So it really puts a spotlight on American, Canadian, Australian, and some African producers that aren't under Chinese control. Really, I think, uh, earn a premium in this market going forward. So it really is exciting times. I mean, for me to be involved in two companies like UEC, where I'm executive vice president, and have joined them, 9 years ago, and seen that company go from really a Texas startup with smaller operations in Texas to now one of the fastest growing uranium mining and development companies in the world today is pretty exciting. And then the launch of URC publicly in 2019 as a capital provider to mines and developers like UEC around the world really is exciting. And I got to be honest, it's a lot of fun. I'm having more fun in my career at this 40 years into it than I've had, and that's with some pretty incredible experience at Uranium One, Cameco, Kazatomprom, as a nuclear fuel buyer, having more fun today than I've had in the past 40 years. So it's exciting times.
First, congratulations to you on the time in the sector, and you've been able to navigate through a pretty rough sector on a lot of different fronts. And so, congratulations on the 40 years, and it's a good position that you're in. So, a great setup you've got. I want to talk just briefly, and good overview, by the way. I just want to come back to and just get a few thoughts on fuel cycle events, but give us the Scott Melbye opinion of, how green is green energy and how clean is clean energy.
Yeah, I think we've always known that it provided carbon-free, clean and safe energy. It's as clean and carbon-free and safe as wind and solar. But our technology runs, 95% of the time, 24/7, 365 days a year. And, that I think we've seen a lot of energy policies around the world be based too much on ideology alone and not enough math and science. And clearly, nuclear is the math and science in the equation. And so it really is exciting to see that acceptance. And it's most evident to me in the United States, where I spend a lot of time on the Hill lobbying on nuclear energy and uranium and fuel cycle issues. And in my entire career, I've never seen such bipartisan support. In the past, we always got support from the political right and conservatives who like nuclear as part of an all the above energy strategy, but the left absolutely abhorred us. And it was a hatred towards the nuclear industry that is kind of similar to the animosity I see from the left towards fossil fuels today. So to sit here in 2023 and be able to go into a Democratic senator or congressman office and be welcomed the same way as we would on conservatives and Republicans on the right really opens the door for a lot of things. And I think licensing of new reactors, we still have, there still are some on the very far political left that embrace nuclear power but don't embrace mining of anything, and that would even mean for electric vehicles and the green energy economy runs on nickel, lithium, cobalt, copper, uranium, and there's still on the far left that don't want to mine the materials that provide all those great things in the green energy economy. But I think they're coming around to it. But basically, the support for nuclear power is strong. I mean, you see it recently in some of the Senate hearings for Commissioner Jeff Barron on the NRC, where there's been a lot of discussion: is he pro-nuclear enough to be reinstated on the NRC commissioner level? And I think if we get a situation where both Democrats and Republicans are encouraging their people that they're appointing to the NRC, not to obstruct or slow walk nuclear power, but actually fast track SMR and advanced reactor type licensing activities, then I think we can see the growth. Here in the United States, I know the first of a kind reactors are coming in. The SMRs in Idaho, Wyoming, Texas, up in Ontario with GE Hitachi. These are very important. We have to build these on budget, on schedule, And I think if we can demonstrate that success, there are thousands of these SMRs coming in the next decade, 2030 to 2040. And so we have, an industry today which, the production consumption gap is largely determined by the large reactors that are in operation and the some 60 more that are under construction today and more coming all the time. But wait till you layer on SMR demand. Each SMR doesn't use as much uranium as a big reactor, but when you build enough of them, it really provides something that we haven't seen in a long time. We're used to the nuclear growth and the uranium demand line being, flat or even declining during the post-Fukushima era, and now we're seeing that grow again. So we have the gap, growing not just from production cutbacks and shortfalls or slow ramp up of new mines, but you're now seeing, demand widen that gap. So as an industry, we've got to get busy. In the West, I think we have to focus on moving away from Russia completely and permanently, frankly, and also guard against, China. They are the fastest nuclear uh, growth country in the world today. They're taking a very long view in securing their uranium supplies, whether it's in Kazakhstan. And we should touch on come back to Kazakhstan because that is a huge elephant in the room right now that it maybe isn't focused on as much as it should. But Chinese gobbling up resources there in Africa and elsewhere. And so in the West, I think we need to look to really build up our uranium conversion and enrichment capabilities to be self-sufficient like we were prior to kind of opening up the market in a post-Soviet era. So exciting times, but yeah, nuclear power, it's not the only answer to our energy needs, but it's, I think, becoming a real key baseload source of 24/7 green energy going forward.
Yeah, it's so hard to overlook, Scott, the high quality, high density nature of nuclear power. I mean, this is a very important piece of it, and it may not be the full answer, but it's a substantial answer, and it's probably one of the critical answers. Because there's just not a comparable form of energy that I can think of that we've devised. We all hope for things like fusion in the future, but it's an uncertain time frame that probably you and I can't really have a line of sight to. But I want to come back, and I'm sorry to digress here.
Mhm.
Might irritate the audience a bit with some of my digressions, but you're well connected in Washington. A lot of hot air flows out of there. Matter of fact, probably one of the biggest hot air carbon footprints I've seen.
True.
But just talk about oil and gas, the coal lobby, these other companies that have a competing form of energy. Obviously, these are important sources of energy still today, and will
Mhm.
be probably for quite a while, Scott, for the rest of our lifetime anyway. But a substantial force that has assisted to keep commercial nuclear power as part of a really a bigger mix. Just talk about that, and just your thoughts on that strength of that lobby going forward, and really the reality of a transition for these companies to start thinking about, hey, maybe we should consider entering this business. I mean, I haven't heard anybody talk
We-
about Exxon Mobil enter the nuclear power business. What are your thoughts on that? Because I know that that's a strong force there.
Yeah, well, Exxon Mobil, has made investments now in lithium. I'll answer first and then come back to the political question. But I know it sounds crazy because we've gone, not that long ago from an oversupplied market where mines are shut in. There hasn't been investment in new mines. There hasn't been long-term contracting until recently. I think you see a situation again like we saw in the 70s, which was driven by the Arab oil embargo and high oil prices. But I see oil and gas companies getting back into nuclear. There's already been some discussions in this regard, but I think for them, oil and gas isn't going away, and I think we have to be realistic with that. And I don't think I give a energy talk anywhere in the world where I don't say, hey, the base load of energy going forward, especially in places like the United States where we're blessed with natural gas, should be natural gas and nuclear. And then you have your wind and solar for whatever level you want to subsidize and provide for. But the bulk of the heavy load, if we are moving away from coal, and we are, I hope in some places like Colorado where I live, it doesn't happen overnight, or I'm not going to have electricity, or it's not going to be very affordable. So I think coal is in that transition period out, but I think natural gas needs to continue to be a very important part of our mix. And between that and nuclear and the intermittent renewables, I think you can have a very clean and very efficient and effective grid. So I don't see ourselves as competing with natural gas. I think we're a good complement. We're not going to be 100% of our electricity supplies, and so I think that needs to happen. And I think there is a movement. I do a lot of work with the European Parliament, conservative members of the European Parliament, and I've talked to some members of Parliament in the UK, and they really see the smart green energy policy going forward as a heavy base of natural gas and nuclear as the core. So I think that's good. I mean, I know in the past, I think oil and gas industry may view nuclear as a threat. I think maybe some renewable industry organizations may view nuclear as a threat because it works so well and it is so efficient. But I think we need to look beyond that, and rather than trying to shoot at each other, recognize that it is an all the above energy approach, and all of us have something to contribute. So I don't see ourselves competing with the oil and gas industry in that regard. And in fact, I think I see more opportunities for cooperation when BP invests in wind and solar. I don't really think that's a complement to their core, business. I think it's more to kind of soothe, the woke crowd to put windmills on their annual report and appear green. But I think if they invest in things like uranium, in situ uranium mining, which is probably more similar to oil and gas drilling, collector well, fields and header houses and such. I think there's a closer fit there than there is with renewables. So that's coming. And I also wouldn't rule out, and this may, utilities may say, oh no, that's not going to happen, but utility self-supply or major, you see Westinghouse and investing, in side by side, or Cameco investing side by side with Westinghouse. I think it gets to a point where there is such a supply squeeze and availability of uranium is so critical that utilities that don't have the long-term contract coverage or comfort with that long-term contract coverage will make investments again directly in uranium mines and developments, and that may extend to uranium and conversion and enrichment as well. You see it in GM and Chrysler probably said there's no way they would ever invest in lithium mines. Well, we can see that when you're faced with a real resource competition with the Chinese and others around the world, that investment can follow. So listen, that's not going to happen tomorrow, but I think it's coming, and it really speaks to the strategic nature of uranium supplies going forward.
Yeah, great point, Scott. Utility partnerships, not anything new. I mean, we saw this, I believe, in the 70s and 80s.
Yep.
I think you would remember some of those partnerships that happened. It's an interesting piece in what you said, too, about some of these really, really heavy natural resource consumption businesses also saying that they don't want mining.
Yeah.
Uh, I don't get how that works, man. I mean, even the math and the science don't back up those types of positions. All for mining and natural resources in the sense that it's responsible and absolute with that free markets. And these big resource heavy consumers have to wake up and smell the roses just a little bit here. I mean, there's obviously trying to sway public opinion and these things, but come on, let's get down to reality.
Yeah, we do it better and just take North America, the regulatory standards and the health, safety, and environment, ESG commitments that, producers do here. I think you'd much rather have it mined here. And, with uranium, you touched on it earlier, the energy density of nuclear power and uranium, we have an advantage in that, won't take a lot of mines, to meet this, the footprint is relatively small. I think the expectations of, lithium needs with electric vehicles and battery demand, it's a huge amount of mining activity globally to meet that in a way that I'm not sure how it's actually going to happen. But with uranium, just take the United States. With licensed facilities already in place, it's not unreasonable to see the U.S. industry go from effectively zero in recent years with mines shut in to back to the 20-25 million pound a year range with just mines that are already permitted, licensed in many cases, with existing infrastructure. So I think we fuel cycle is our advantage with our technology, and so we've really got to embrace that.
Yeah. I'll come back to fuel cycle in just a moment, Scott. Get your thoughts also on Kazakhstan. I want to come back to that. But
Hmm.
the NRC, you've been involved with policy and a lot of the politics there in the United States. Is the NRC a significant constraint for build out in the US? And also with that, the timeframes. We've
Hmm.
seen Russia, we've seen China, we've seen the French, the Japanese, the Koreans all excel at
Yeah.
construction and regulatory.
Yeah, we
Why?
got to
What?
figure that out. I mean, we can't,
Yeah,
we can't build these things in 10 years. They've got to be built in 4 or 5, and SMRs maybe even faster. So I do think listen, it's no secret. I mean, in the past, Democrats would appoint NRC commissioners to either kind of tamp down nuclear growth or slow walk it, or in some cases, there were very anti-nuclear NRC commissioners, and that was meant to kind of keep nuclear at bay. If Democrats and Republicans see eye to eye on nuclear power growth and particularly SMRs, well, then NRC commissioners are appointed not with the eye to cut corners on safety and proper regulation of our industry, but take away the obstacles and the challenges to make that process go faster. And I think that really that could be a sea change for growth in new reactors in the United States and ultimately uranium demand.
yeah, the government needs to be a partner. That includes the alphabet agencies. They need to be a
Mm,
partner and they need to be a business partner and they need to look at it from that perspective and be able to get it done because, when other countries who are, at least from the view of the US, inferior to what US technology and US regulatory is, you would think we could beat on budget, we could beat on time frame, and that just hasn't been the case for a number of decades now, Scott. And you and I think we've talked about this in length going back many years ago about how the U.S. should change policy. It looks like that started to happen, and we've even got our friends to the north, the Canadian folks, also helping to lead that a little bit here with some recent activity up there. But why don't we set that aside because we're here to
mhm.
talk about some more detailed issues. But how about fuel cycle constraints? Talk about this on the western end of things, Scott, as you alluded to earlier, but just talk about the issues with conversion, with enrichment, and really what issues that stand out to you at this time. And then
Yeah,
also, can you put a time frame on the time in which Western capacities are built out? Because I think this is something that won't happen this decade.
yeah. Listen, there's legislation before the House and the Senate. Bills have passed committee and Manchin Barrasso's Senate Energy and Natural Resources Committee. It's passed through Kathy McMorris Rogers' committee in the House, Energy and Commerce, that have Russian uranium ban and various initiatives to revitalize the domestic American fuel cycle. So, that's good news. I mean, the committee discussions and negotiations are usually the toughest ones. So now it's really just finding, time that in a right place for these bills to hit the floor for full votes. I think, that if there's any remaining debate there, it's, what is this going to cost? And what is the right way to do it? But I think there's bipartisan support that we need to do it. And, you know, the way to do it, I mean, it could be, you could follow the lead of the Strategic Uranium Reserve, which was very slow in getting put up, but finally made awards at the end of last year, and deliveries were made early this year, which was really great. It spread that benefit even at 75 million across to 5 different U.S. Uranium producers, and of course ConverDyn. But that model did work, and I think when we're on the Hill this week lobbying, we're going to say continue whatever you do with conversion enrichment, which is a bigger, tougher nut to crack. That the Strategic Uranium Reserve works and can feed into whatever solution you come for those other fuel cycle components. But there's also discussion that, well, okay, utilities may not want to see government competing with them in terms of purchases for scarce materials and commodities. So maybe production tax credits are a better way. Maybe cost sharing is better. Maybe enrichment and conversion plants are more like building factories as opposed to mining a commodity. So maybe cost sharing is better there. So I think those still need to be sorted out. But I think the uranium ban on Russia needs to happen. For moral, ethical reasons. What Russia's been doing for over close to 16 months now is appalling by any measure. We don't need to be sending $1 billion of nuclear fuel purchases their way each year. So on an ethical basis, we need to move on that. But on a business basis, the sooner we break our addiction to Russian uranium conversion enrichment, the faster we can revitalize and build up our own, not just US, but Western capabilities. And I think that will happen. Now, the catch-22 is utilities don't want to step up and provide really big commitments to say the converters or enrichers for new contracts that would underpin these additional capacity expansions until they really know, okay, are we moving away from Russia, or is Putin going to apologize to Ukraine and make nice, and then we go back to that reliance, which I think is a big mistake. We've learned a lesson here. We've had a near-death experience on Russian reliance on nuclear fuel. We need to move away. So I think the answer is clear, but I think until that happens, utilities are reluctant to step up and contract for new conversion enrichment contracts at the prices that are needed to support that build out. I think on the uranium side, it's already beginning. The utilities are contracting, in very significant long-term volumes again. And remember, long-term contracting over the past 7 or 8 years, if you look at those bar charts that UXC puts out of the total volume of long-term contracting each year, a lot of those volumes for the recent years have been carry trades with trading companies, where the trader buys abundant spot supplies today, carries it on their books, delivers at a fixed price. Those weren't long-term contracts with producers, but that's happening again. And that is providing a nice underpinning for miners and developers to move forward and get back into production. But I think if you talk to the converters and the enrichers, they're ready to expand and willing to expand, but they need that commitment from utilities. So I think as an industry, we're going to need to kind of, step up here and move forward. But I honestly think it can happen. We dialed back our industry to make room for the Russians after the breakup of the Soviet Union. Now we just have to go back the other way. It's not like we don't have the technology or resources to do it. But I think it will be a Western solution, Europe, Canada, the United States, providing that Western nuclear fuel cycle.
Yeah, lots of work to get done there, Scott, and it's quite a game being played, as you know, with the Russia, Ukraine, and U.S. involvement there, and all the issues surrounding that, which is for a different conversation. But how about we move into URC here specifically, and how about you just give us, because it's been a while, how about just a quick update on the capital structure of the company in terms of shares outstanding, cash on hand, and if you don't mind, the major shareholders that you'd like to mention.
Yeah, so we launched URC publicly on the TSX Venture Exchange in December of 2019. So a couple of years prior to that, we kind of formed the company. I'm a co-founder. We basically looked out at the huge industry, the $50 billion industry that's become royalty and streaming in base and precious metals, with companies like Franco-Nevada, Wheaton Precious Metals, Sandstorm, Royal Gold, any number of these companies that have become so popular with investors as a pure play, diversified exposure to particular commodities. It also has become a real go-to source of development capital in those other commodities. Royalties and streams are no longer alternative finance in those industries. They're go-to right alongside debt and equity to build new mines in other commodities. We just, it was amazing. We didn't have such a vehicle in our industry, and maybe it's because we weren't building anything. We were, if anything, we've been shutting in mine capacity. We've been deferring new mine development. And so there wasn't as much a need for the company. So, people might have scratched their heads when we launched, when we did, but boy, are we glad to have the company fully up and running and running on, full speed ahead in 2023, because we really are, now positioned to be a capital provider to this next generation of mines and developments that are going to help meet this gap. And, we see it as a significant gap. I mean, if you assume the Cameco Orano mines are going to produce at full capacity, you assume Kazatomprom and Kazakh production's at 60 million pounds a year. Not sure whether much of that makes it to the West or not, but it's certainly going to be at that production level. We believe you need probably 8 to 10 new mines coming online between now and 2030 in Australia, Africa, US, and Canada. Now, not all of these new mines are going to be 18 million pound a year mines. Some are going to be 1 or 2 million. So hence, a lot of development needs to happen. UEC, is well positioned to provide 2 production centers in that group in Texas and Wyoming. But URC, and this is the part of my job that I enjoy the most, is being able to come alongside this next generation of miners, developers, and provide the capital dollars they need to get into production or get over the hump with a economic assessment, or complete a well field, or complete a processing facility to get into production. And so we're well positioned as we sit today. We still are the first mover in the space, well positioned with a balance sheet of 147 million in cash and liquid assets, so we can fund acquisitions without having to go back to equity markets at this stage. The physical uranium ownership, I can get into that a bit, but that presents a nice asset that's appreciated nicely since we've acquired those pounds. And it also provides, we can turn those pounds to cash to fund royalty investments as they come up. And then the existing portfolio, we have 18 royalties in the sort of inaugural portfolio that URC has. And now, fortunately, we're seeing a lot of those mines restart or come back into production, like McArthur River, Cigar Lake, Peninsula Lance, and Langer Heinrich. So we're getting back into a cash flowing status again in 2023, and really focused now on expanding that portfolio. A couple other things I'll mention. I mean, we did launch on the NASDAQ 2 years ago, and with the UROY listing, and I will say that really increased our trading liquidity. We don't trade as liquid as UEC, which I think is the second most liquid uranium equity, just behind Cameco, but it did quadruple our trading volumes over the TSX Venture. So that was a good development. And then last week, we did graduate to the TSX Big Board. So those are all great developments. Our share structure is quite lean, and with 99, almost 100 million shares outstanding. Our ownership structure, I mean, we have some of the foundational ownership. Obviously, UEC, being a major founder, still owns 18% of the company, but other, sort of corporate founding owners like Altius and Mega vended in assets in exchange for shares. But we have a number of the, we're in all the uranium ETFs, in the, a key holding of resource funds that are focused, like Commodity Capital, Extract Capital, KCR, some of these others that have been early kind of investors in the uranium space. And we're making a lot of inroads with kind of the generalist institutional investors now as well. I've been on the road much of this year, either meeting with royalty counterparties to generate new business opportunities. Like I've spent a week in Australia, in Perth and Adelaide, meeting with all those miners and developers down there to see what are their capital needs, what do they need to get over the hump into production, and what can we do to help them. But also meeting with institutional investors in Asia, Europe, and North America to really tell the URC story. And it really is resonating. It's a bit of a diversified approach. An investment in UEC is you're investing in in those mines in Texas, Wyoming, and the development pipeline in Canada. It's very specific. With URC, you're buying a portfolio where in our 18 asset portfolio, some are going to outperform our expectations, some are going to underperform. But hopefully, if we've done our due diligence and we've made the right accretive acquisitions, we'll be in a good position. And again, it is a growth platform. So look for growth. We have a number of files on the go right now. And we do seem to be a good fit with, as great as the uranium story and nuclear energy story has been, a lot of the uranium equities have been trading perhaps closer to their 52-week lows than their highs, which is crazy. And I think it speaks to just pressure of the broader markets and uncertainties. Is there a recession? Isn't there? Regional bank failures, I think, has really weighed on the uranium sector, with the exception of a couple sort of leading companies like Cameco, which hasn't really pulled back with the rest of the pack. But it's not an attractive time for a minor developer to issue a lot of shares, and maybe some, even if their share price was higher, they've already, diluted to get to this, to survive a 10-year bear market and get to this stage. So, a royalty and stream may look pretty attractive and be the lowest cost of capital. Debt is another alternative, but again, comes with a lot of covenants and strings attached, and obviously higher interest rates today. So I think we are resonating. Some are opportunities, just miners, developers that had raised equity capital to get into production, but maybe need just a top up to get over the hump and into production. A royalty and stream makes excellent sense there. Others may be buying plant and equipment in advance of when they normally would with supply chain challenges. And, we can almost become an equipment financer in those instances. But again, there's a number of opportunities of restarts, new mine developments, byproduct production that give us a nice pipeline of opportunities right now.
I want to come back to just to stay a little bit on cap structure and broad overview, and then I want to dive back into a few things you said. There is this comparison to royalty and streaming companies that URC has made, who are primarily, of course, in another segment of the natural resource sector, and that's precious and base metals. Mm-hmm. And obviously, there's a scale-up period, of course. URC is kind of on the lower end of that curve, and people can refer to this because you've highlighted it in the presentation. But, mm-hmm. How similar do you think this is? Because uranium's so specialty, and it's actually a few extra layers of difficulty. How similar do you think that comparison is, Scott? And do you expect more competition, too, in terms of royalty streaming startups as the uranium sector gains more attention?
Well, if it is such a great structure and model and the right commodity, we won't be, the only player for long. And so we do expect competition at some point. It is different than, the name of the game in gold and base metals royalty companies is you can go out and acquire another royalty and streaming company and acquire, 15 assets with one M&A acquisition. So it's, we don't have that luxury of being able to just go out and buy a company and double our portfolio size. So we've got to go out and really dig. But this is where our 40 years of uranium experience and we have a very small team, but a number of folks that have been engaged in uranium exploration, uranium mine development, marketing, many of which with companies like Cameco for much of their career. We get it. We get the risk return proposition that's offered in uranium. We know how hard it is to license, permit, get mines into production. We understand all that risk, but we're willing to take that risk, as a pure play uranium company. So, that's an advantage that we have. But it does, we've got to do our homework. Like I would say the Cigar Lake, McArthur River royalty acquisitions were a good example where, it wasn't, with the counterparties or the operators themselves. It was with Reserve Oil and Minerals that was engaged in uranium exploration in the Athabasca Basin in the late 70s, early 80s, was part of the discovery, sold their interest to the provincial and federal governments back in the day when that was occurring in the early 80s, but retained a royalty. And we knew that Frank Melfi in Albuquerque, New Mexico. He's 97 years old. I went down and saw him during the height of COVID and kind of Black Lives Matter riots in that summer, and went down and saw him, drove down to Albuquerque and saw him, and made a deal for those royalty assets at an $11-12 million acquisition, which, that's the kind of homework, and that's the advantage we bring. There are other known existing royalties that we're pursuing kind of in the secondary market to add to the portfolio. But I will say that, of the 5 or 6 files we have ongoing right now, all of those are new financings. So they are providing fresh capital to a minor developer to get over the hump and into production. So again, it's a great model for a great commodity at the right point in our uranium commodity cycle. And I think, if there's one challenge I have, it's really educating CEOs and CFOs on the value and benefits of royalty and streaming over debt and equity. A lot of what I do is kind of educating, and there may be a perception that, oh, well, so we'll come to you for a royalty and stream if we have no other alternatives or not great alternatives in debt and equity. And we're like, no, we'll actually structure every mine and development is different, has different risk profiles and discounts applied to it, but we'll tailor something against the developer's other sources of capital and come in as the most competitive source if we can. I mean, it might not be able to given some circumstances, but we will tailor our proposals to be the lowest cost of capital. So that's a big education, and that's why I've been out on the road, made the rounds through Australia. I hope to get to Africa and do the same, later this summer, early fall.
Yeah, Scott, I think you're going to need every bit of that cash you do have on hand because, as you know,
Absolutely.
some of these transactions that are coming down the pipe are multiple hundreds of millions of dollars if you want to be able
Yeah.
to obtain some of these deals. And it sounds like you guys are portraying yourselves as good as a bank, if not potentially better on competition with interest rates where they are today and so forth, I suspect. And because you guys are the only one in the sector and you're aggressive, I suspect that competition, if someone's going to seek a proposal from a bank, then why not seek a proposal from URC is what I would probably suggest. And then the other part would be just the consolidation of these royalty portfolios. As you
Yeah.
said, there's a lot of individuals and just unknown companies out there that are dormant that have these royalties. And
Yeah.
it makes sense from a competitive standpoint to consolidate those. There's even a handful of companies in the sector, as you know, that hold a little
Yeah.
bit of royalties on different projects that can be consolidated into URC as well. So that's pretty interesting in the sense that there's a lot of things you can actually do with it. It's a flexible vehicle. You talked about, competing with, Caterpillar, Komatsu Equipment Finance, et cetera, for maybe equipment purchases, long lead times, which you and I both know are a big deal, and you should be doing your homework on lead times for processing equipment and so forth in this day and age. Just speak briefly about, I know the company's growing and that there's kind of this fixed overhead to start out here, but, one of the attractions for investors is that, as these royalty stream companies grow, that generally the fixed cost of overhead stays the same. The staff's generally
Yeah.
small. Just talk about that bit and specifically
Yeah,
to
that's a big
URC for a moment.
advantage. And our team is quite small. We really 5 employees, some of which are shared responsibilities. We have, as an advisor, for example, we've got James Hatley, who can come alongside us and do due diligence when we're looking at potentially investing in a conventional mine operation. And for a guy who was a mine engineer at Cameco with MacArthur and Cigar, that's huge, valuable resource. But he's available to us. He's full time at UEC. Darcy Hirschhorn, our chief technical officer, spent over 20 years in global exploration with Cameco and performs the resource assessments and determines, did the company do the right, apply the right processes and oversight and governance on their drilling programs to determine the resource and everything else. So we've got them, but this small team and our small board that is a very active board, or they're providing great counsel to us. we can triple, quadruple in size and not have to add significant staff. We don't own the mines. We don't have the huge workforce. We don't have the land holding costs. We just have to make sure that we do the due diligence and we, out of the universe of potential counterparties, we align ourselves with the winners in that group. And so it is quite nice. I mean, I think our G&A, will be in the, 2 to 4 million annually range. It depends on how much IR activities we have, how much due diligence we have. We've kind of got some costs that are pretty steady, like uranium holding costs and storage costs for physical uranium that we hold at Cameco. But it's a really effective, and our goal in the near term is to really obviously get into the cash flowing stage, cover our G&A costs, and then all the deals we do after that are all gravy and adding free cash flow. And that's where you get, I mean, I'm so envious when I look at the mature royalty companies and to be in that position where they're throwing off so much cash. I think when you measure the cash generated per employee, these are the most efficient companies in the world in that regard. And so those are the models. And listen, when I took on the CEO role in 2019, I'm a uranium expert. I spent my whole life in uranium, but I wasn't a royalty and streaming expert. So I really dove into essentially almost the case studies of all the other major royalty companies and try to determine, okay, what did they do right? What are the best practices? What did they do wrong? And try to really position URC to not reinvent the wheel, but just take the best practices in base and precious metals and bring it to uranium.
It is an interesting model, and it can work out pretty well, especially if you can load the portfolio with stuff that actually will cash flow out here within a reasonable staged set of timings that come into
Mhm.
that. But actually, I want to get to that for just a moment and get your thoughts on where you see the immediate income sources. Maybe talk immediate, and immediate being maybe say over the next 18 months in this sector is,
Yeah.
is immediate in my mind, but maybe midterm as well. What do you think are the sources to come? Just talk about maybe some of the counterparties and when you see in those come online.
Sure. And before I get into the royalty assets, I'll just touch briefly on the physical uranium investment because obviously that can be a source of cash and pretty significant profits. When we launched the company, we realized that even with the existing royalties that we put in the inaugural portfolio was going to be a while until they started to cash flow. We had an industry where mines were shut in for good reason. We're quite happy for them to be shut in, but now 2023 we see a number of those assets coming back into production and cash flowing. But we needed to really provide value to the early shareholders, and we decided to give them exposure to physical uranium near the bottom of the cycle as we were coming off the bottom of that cycle. And so one of our first investments was an almost 10% share of Yellowcake PLC out of London. And with that came strategic, not only gave us uranium effectively at $20 a pound or less, it gave us rights to purchase uranium from Kazatomprom under their long-term arrangement. We did that. We tapped some pounds there and have since made open market purchases, which amount to over 1.5 million pounds to date at a weighted average cost of $43 per pound. So already, that provides a nice asset on the balance sheet for us. We've got additional offtake materials coming in from CGN, who operates the Husab mine. Deliveries begin later this year, but that's a 3-year offtake. It brings in 500,000 pounds at an average cost of around $47 a pound. So we are realizing the capital appreciation of that on our balance sheet. When it comes time, we can turn that to cash. Obviously, we'll be very disciplined sellers of that into market strength and not to impact things negatively. These aren't huge volumes, but we'll be very careful in that regard. But then, if you get to the royalty assets themselves, I mean, the first one I'll speak to, two that I'll speak to are McArthur River and Cigar Lake. So with McArthur and Cigar Lake now back in full operational status, whether they were shut in for market reasons or COVID reasons. That period's over, and they're ramping up to higher, if not full, production levels. McArthur River is an interesting one in that we have the ability, and we've elected that right, to take physical uranium payment under the royalty. So we're accruing pounds to our account as we speak, and we'll take book transfers of that value at Blind River each year, and maybe twice a year. The value of that royalty alone at current prices and current production levels is a little over $1 million a year. Obviously, it will go up as uranium prices go up. Cigar Lake royalty is a net profit interest, and it will ultimately be bigger than the McArthur royalty. But as it is a profit interest calculation, there still are some expense bucket, if you will, has to be drawn down before that happens. So the more Cigar Lake produces at the higher prices it achieves, the faster we get to our cash flowing state. But it will be bigger than McArthur at that stage. And I would say within 3 to 4 years that these two royalties are throwing off, I would say, $5 million. All depends on production levels and uranium price. Could be significantly higher if uranium prices take off. Another royalty asset we have in Saskatchewan is not a near-term cash flowing royalty, but it is seeing value crystallize, and that's the close to 2% NSR we have on Rough Rider. And that asset held in Rio Tinto's hands, acquired for over $600 million. They'd done 150 million in mine development and kind of early development activities or licensing activities. That project has new life under UEC and much more focus to make Rough Rider part of a hub and spoke, if you will, of operations in the Eastern Athabasca Basin. So we probably will see royalties coming sooner under Rough Rider than they were under with UEC than under Rio Tinto. US ISR royalties, we have interests in Reno Creek, Lance, Dewey Burdock, and Church Rock. We're obviously very high on US ISR for the reason that these are some of the most readily restart mines in the world today, have low capital costs, low operating costs. They're not the world's biggest mines, but they're profitable mines in this environment. And so, Reno Creek obviously figures into UEC's hub and spoke in Wyoming with Irigaray processing plant only 30 miles away. Lance is in the process of restarting their operations this year. We have a pretty comprehensive royalty there. We increased our royalty interest there in the last 18 months. Did the same with Dewey Burdock. We had a fractional royalty there that we acquired a more wholesome or more comprehensive royalty on Dewey Burdock when Encore moves that project ahead. It's at their timing, not ours. And then Church Rock in New Mexico. Conventional royalties, moving to Namibia, we have a royalty on the Langer Heinrich mine, which everyone knows is going through a very significant recommissioning, if you will, of that mine that has produced several million pounds through the years, now being restarted under kind of improved economics and reconfiguring some of the mining and metallurgical processes to lower the production cost there. It was a good time. They went through all those activities and now have the benefit of a higher uranium price as well to sell into. But with them restarting in the second quarter of next year, we'll start to see cash flow under a fixed royalty under that operation. And then their Michelin project in Labrador, obviously a longer term tuck away for us, but is a 100 million pound asset that in a bull market again will start to take shape. And then we have a whole slew of 7 royalty interests in conventional mines on the Colorado Plateau: Arizona, New Mexico, Utah, Colorado. We've got the Anderson project, Anderson and Workman Creek in Arizona, Roca Honda in New Mexico, Slick Rock in Colorado, Whirlwind, Energy Queen, and San Rafael in Colorado and Utah. So these are projects that, the economics of conventional uranium mining is different than ISR, but does benefit from milling capacity, with Energy Fuels blending mill in the region, and the benefits of vanadium production and rare earth minerals. So we're quite happy to have those royalty holdings in the mix. So again, that's where we're at presently. And again, a lot of our activities in terms of new royalties are focused on projects that can um, either restart or start up as a new operation in this cycle and start cash flowing, or if they're not going to be immediately cash flowing, are operations that will see a real advancement in their business models in a bull market that I believe we're in the first inning of right now. So very active with those various miners and developers around the world, and we'll see how quickly we can grow the portfolio.
Yeah, Scott, it's a good start. And you and I both know there's a handful of other royalties out there that I know you guys are going to pursue quite hard, and good luck with that. And I think it's a good start up here to just highlight that Langer Heinrich would be one, MacArthur River, Cigar Lake. These are something that's definitely coming down the pipe to you guys as well. And then you, of course, have a few assets that are restarted in the US that you guys have exposure to. Near term cash flows that'll start to come into the company. And I wanted to ask you just to come back to two other things: the strategic partnership with Yellow Cake and the option to purchase pounds with them. Talk about that briefly, and then also with regards to offloading some pounds that you guys have in inventory to potentially help finance some of these bigger deals that you would be looking at, Scott, which are 300 million north that you guys will want a good chunk of. Just talk about the need to really offload that into the spot market versus potentially offloading it to a counterparty like a utility.
Yes. So in terms of sales, I mean, URC is very much unhedged by nature, right? We want to give our investors exposure to the commodity and all of its upside. So we probably wouldn't sell those pounds into a contract that might cap the upside, whether it's base price or market related with a ceiling. But with 40 years of experience in this business, I do have a lot of relationships with the utilities, with traders, with financial players, even new players emerging in the SMR space and elsewhere. We'll take I would say, a very sophisticated approach to selling, just as UEC does and will on their side, where we'll be much more spot market aligned and focused. Doesn't mean that we're not dealing with utilities or sort of those type players, but we're more focused on getting the highest price for our investors rather than hedging someone's upside risk. That's not our job. So we don't see that as a problem with the spot market. Trading anywhere from 50, 80, could be 100 million pounds in a year, and new players like Sprott coming into the game, we really don't see that as a challenge, converting those pounds. With Yellowcake and Kazatomprom, we exercised, I believe it was 350,000 pounds under that arrangement a couple of years back. I want to say, yeah, the total option is up to 21 million US total. So that would be the total that we have option rights on, less what we've purchased. So we can tap that for additional pounds. I don't know how that would work today with transportation and logistics with Kazatomprom, and they're having a challenge, I think, making their existing commitments to Western companies with the Caspian Sea, Armenia, Georgia trade route. So I don't know what that would look like today. And I mean, that touches on the other point with Kazatomprom. I think between Russia and China and the investments and the control that they exert in that country, they'll continue to be the world's largest producer. But I think much of that uranium goes to those two neighboring countries rather than the West. And that's the elephant in the room, I think, is that we're all focused on Russian sanctions and when will there be a ban. I mean, I think the world's largest uranium producer in a bifurcated market really isn't for the West's benefit. And if you don't believe that, just ask the Russians, and I'm sure the Chinese, would tell you too that that is their focus of securing those assets that aren't under the control of the EU, of the UK, or the US. So it works both ways.
Yeah.
Does that answer the question?
No, and I agree with that. It's clear that the alignment is there with Russia and China, and it's a risk. It's a big risk if you're in the country. That's a big risk operating there. Any Western company that's operating there would want to be careful about how they approach that relationship, and then also just the sheer time frame it's going to require in capital to get back to that production state that we witnessed over the last, call it the last decade, or going back a number of years. A lot of capital there, not to mention the significant depletion that's happened there. So it's going to take time to get that going again. And then the management changes, Scott. You're seeing this, all the management team being changed out. And
I mean, I worked there. If anyone doesn't believe that Russia has influence over Kazakhstan or Kazatomprom, I got news for you. I mean, that's the reality. And
yeah,
doesn't mean that Kazakhstan isn't an independent country, but they have two very big neighbors who, I mean, it's a pro and a con for them. Yes, they have two big neighbors that covet their uranium supplies, but that's also a positive. They also have two very captive markets there that don't require transportation challenges like they face getting stuff to the West. So, they will continue to be a major global uranium producer, but much of their production is going to those two countries, which is different than where we envisioned things going a few years back with, opening them up to the West.
right. Yeah, take advantage, of course. I know you will to the best of your ability with obviously maintaining the relationships, because I know there's a lot that goes into discussions here, but acquiring whatever pounds you can acquire at today's prices are probably still going to be quite suitable, and
Mm-hmm.
take advantage of that. And we talked a little bit about some of these bigger deals that I think, Scott, are going to come across your desk, or as you said, you've already talked to a number of folks and have posed what you guys can do for them on some of these bigger development projects. But let's say, for example, let's say a developer's putting together a financing package of 300 million US dollars to build out a project. And there's a couple projects that would fall into that number.
Mm-hmm.
Um, and they come to URC, and let's say there's a deal to be struck, a good juicy deal for URC that maybe takes down 100 of that, 100 million of
Yeah.
that. Um, how would you approach this in terms of, you guys have existing cash, you have some uranium inventory that you've profited on already, but then
Mm-hmm.
also you've got the equity, which is going to be difficult. Raising equity today is a little more difficult than what you would expect later on in the cycle when URC is trading higher. But how would you couple piecing together a juicy, bigger deal that would potentially see cash flows back to URC in some cases within a couple of years?
Yeah. Well, the average, call it ticket size of some of the opportunities we're looking at right now are anywhere from 10 to 50 million dollars for each opportunity, but there are the $100 million opportunities as well. And with those, we're probably not going to be the only source of financing. We're going to be part of the capital stack. So those bigger developments are going to tap debt. They're going to tap equity and royalties and streams. And with the bigger opportunities, we may need to get creative and more of a structured finance approach, and potentially bring in partners that, who's to say we can't provide an element of royalty and stream and come alongside with an equity investor as a package deal. So that's definitely the case. The uranium can also be, doesn't necessarily have to be sold. It could be valuable to some of the potential miners, developers, as they, are getting into production. Obviously, they value the cash to build the mines, but, the uranium can be a currency as well with some of those opportunities. So we're looking at that. I mean, listen, make no bones about it. We're trading, anywhere between 0.5 and 0.6 P to NAV right now, very similar to UEC at a similar level. Whereas royalty companies tend to trade, at a premium to NAV, and that's part of the success. So, we aren't eager to sell more shares here to do more deals. We want to be, when we're trading at a premium to NAV and can raise capital and make accretive transactions, that's the secret sauce. Now, wasn't that long ago, 2 years ago, we were the best performing royalty company in the world, even better than the base and precious metals royalty companies. And we were a top 5 uranium equity in terms of our our gains in that year. So believe we'll be back at those levels. I think there is kind of a wet blanket on the uranium equities, which is ironic because the industry has never been in better fundamental shape, and the well-positioned companies have never been better positioned to take advantage of that yet. It's not being recognized in the equity share prices. And I think once the broader markets, it's so skittish. It's just, yeah, I realize the NASDAQ's up, but it's up on a lot of kind of a smaller number of AI tech stocks that have really driven that index. I think when the broad market, investors have that confidence that we're moving past recession fears, bank failures, all the things, interest rates that have really, kept things down. I think you have a rally in uranium equities that, will rip your face off. And, obviously some companies are going to do better than others. And I believe I'm involved with two of those companies, but, that will be a time where, we can raise equity again, to replenish. But what's nice is in the near term, we can bite off, of the files we have in front of us. Who knows whether all of them come to fruition or none of them do, but we can finance, a number of these with our own balance sheet. And it's only if we're super successful that we might have to come back and raise more equity, but hopefully that's in a better uranium equity environment.
Yeah, I think that's well said, Scott. And I think the strategy, you guys have thought through this quite a bit on how you're going to approach this. I want to move on to just a few other things, Scott, before we wrap up. There's a few other topics that I wanted to bring to your attention and get your thoughts on. As you mentioned, you guys have had a number of approaches and you've approached a number of companies out there, whether it be restart developers as well as developers of new uranium projects, which
Mhm.
you and I know a number of those as well. And all of these projects have their problems, but you've also looked at them from a technical and expertise point of view, given
Yeah.
your expertise and your long time in the sector as well. Coming back to what you said earlier about, the potential for maybe 8 to 10 mines. Maybe
Yeah.
I'm assuming that's both a combination of restart and also new build. But what are your thoughts on the companies actually getting over the finish line, Scott? Because this business of production is very difficult.
Yeah, it's well, honestly, this is the best part of my job, though, is to look out at that universe of those companies, and I can't tell you how engaging it is to sit down with the CFOs, CEOs, and say, okay, what actually do you guys need to? Is it completing the central processing plant? Is it a potential? Maybe it could be a cost overrun due to inflationary um, developments since the original cost estimates were made, or is it developing a certain part of the mine plan, and being able to say, okay, here's the 30, 40, $50 million to come alongside that. Do I think we can build those 8 to 10 mines? I actually do. I just don't think it's going to be fast. And some of the fastest mines to respond are frankly in the US with ISR. And we didn't really talk about UEC's activities, but with Ready Start existing infrastructure in places like Texas and Wyoming, these are mines that can come on quite quickly. But again, they're 1 to 2 million pound annual production. Um, I think in Africa you have a slew of developers in Namibia, in Mauritania, in Niger that are really advancing the ball. And whether it's a Global Atomic with the DASA project, in Australia, you have obviously projects like Honeymoon that are really screaming ahead towards restart of those production, and Langer Heinrich as well. But even like restarts like Langer Heinrich and Honeymoon required significant capital investment in many cases, in both those cases, reconfiguring the mining and metallurgy of those projects from what was used previously. So um, they have an advantage as a restart, but they still have a lot of work and capital to deploy. And so, this isn't easy. None of these mines are easy, but I do think there, yeah, there are a couple mines out of those 8 to 10 where it's hard for me to kind of identify, okay, well, who is that? And that's, there are a number of projects out there in a development stage that need to step up. And, some of the bigger ones in Canada, obviously, are not going to be immediate producers. But by the time they come on, that production's needed. And that means, whether it's Denison's Wheeler River or NextGen's Arrow, those are bigger mines. But by the time they come on, that production's needed. That will be needed to fill the gap. It's not, we used to think of those projects as, oh my God, what happens if they come on and they're going to create oversupply? No, like they're needed in the gap with mines like Octala and obviously Ranger and Niger mines shutting in, basically reaching the end of their mine life. We need to replace that. Even in Canada, I mean, Cigar Lake Phase 1, is coming to an end in this decade. Whether they go to Phase 2 or not is to be determined. But even, the world's biggest mines don't go on forever. And so that next generation needs to step up.
I agree with your viewpoints on this in the sense that, a lot of people still think that, things like NextGen are somehow going to impact this market. I don't know that the timing lines up right. There's just this thought that somehow NextGen's going to put 29 million pounds into the market in a couple of years. You and I both know, we've been here long enough, you way longer than me, know that these things never go perfectly. And this is a record setter, by the way, and setting records of production, lead time, construction time frames, and large capex.
Mm-hmm.
That's a lot of records to set. So it's a difficult one to get a pin on, who's able to get there, the technical problems with some of these projects, the risk tolerance with respect to the jurisdiction, and all the other issues we talked about. A lot of these need to be dusted off again and recosted with respect to the economic studies. And there's just a lot of pieces
That's
that go
definitely
into
true.
this.
I mean, if the economic study is more than, 3 or 4 years old, you might as well throw it away and redo it because everything's gone up. I mean, UEC's seen that in Texas and Wyoming. Fortunately, they're still, at all-in cash costs below 40. So, it doesn't price projects out of the market, but they're not as low cost as they were originally envisioned.
Right. Okay, I'm going to come back to UEC in just a minute, but just one more question here on URC, Scott.
Mm-hmm.
Just talk about some of the community relations, government policy, wisdom transfer work. I mean, this industry is aging, let's be honest. Talk about that work at URC's level to bring up new talent, technical talent preferred, of course, just general skills, because normally a lot of this work is being done at the counterparty level, Scott, not necessarily at the royalty stream holder level, but just talk about that side of it.
Yeah, we're not even joint venture partners, if you will, in these projects. We're royalty holders, so a lot of our technical work is done in the due diligence of deal formation. But it's very important that, and sometimes it's a curse and it's a blessing because we get it. We, unlike a bank which may not understand everything fully, we get how long it takes to permit a line. We know the challenges. We know the geopolitical risks. So sometimes that causes us to discount a project maybe more than someone else would. But there's other times where we see value, or maybe believe in value that even more than what the operator has in certain cases. So it's really just, technical people on our team, people like James Hatley, Darcy Hurstcorn, some of our board members that have brought, decades of capital markets experience. I mean, I mentioned Neil Gregson, who was the head of JP Morgan's Global Asset Management Resource Fund. Enormous resource for me to go to when we're looking at approaching or closing a royalty deal. So it is a big concern. I mean, for the miners and developers, it is very important, and we are facing now competition amongst miners developers for plant equipment, drillers, technical people. Some places, I mean, I talked to a Niger producer recently that said, no, we don't have a problem because the last generation of mines, are shutting in, but we're now providing jobs to people who are out of work. So it's, there are also opportunities in that. And I think, sorry to come back to UEC, we were always very cognizant of the knowledge transfer. So even though we contracted dramatically in the bear market and really went to kind of survival mode in those years, we retained our real key exploration, mine development, operations, permitting and licensing people. And even if some of those are getting up in years, we made sure that we brought in, someone from Texas A&M to work and study underneath them to learn everything that they've learned throughout their career. So when they do ultimately retire, we've got continuity, and that's hard. Bench strength's hard in low market price environments, but I think companies that have done that will really have a leg up.
That's the biggest thing we need is this technical talent replacement and that wisdom transfer, because you've just got so many other factors that are weighing against that, whether it's be undercapitalized markets, stubborn people, let's be honest. These types of things that really impact this piece of it, and real expertise on the ground. And we know how much that is important, because those people make the people look in the chairs a little bit smarter. So anyway, let's move on here. Let's talk UEC just a moment here. You're the executive vice president over there at Uranium Energy Corp, of which has a strategic relation with URC. Just talk about what conditions in your mind that you can share on uranium price, maybe the contract book that you think UEC would look to restart production.
Yeah, well, it's an understatement to say the last 18, 24 months have been exciting, because it really, we've seen, as I mentioned earlier, I mean, when I joined the company, this was a small Texas startup, and now, one of the fastest growing uranium companies in the world with multiple hub and spoke production centers. But, over this 18 months, they've made close to 560 million in accretive acquisitions between Uranium One, UEX, and Rough Rider. That's tripled the total resource that the company controls, and a 4 times increase in licensed production capacity. Not to mention providing now a longer term production pipeline in Canada, particularly the Athabasca Basin. So it's an exciting position to be in. So where we sit today with uranium price at 56, UEC has been quite unique in that we've decided to be and maintain a 100% unhedged approach to the book. We just feel that given our size and our sorts of financing that we have, able to, with a strong balance sheet of 125 million in cash and liquid assets, we're not building a $2 billion underground mine that produces 20 million pounds a year, where it is going to make sense to have some of that some of that production under contracts and de-risk. We want to preserve all the 100% of the upside of our production, which starts out, very small, 1 to 2 million pounds a year in Texas and Wyoming, ramping up to 4 to 5 million pounds over 4 to 5 years under the right conditions. That's very easily manageable in not just the spot market, but through those strategic relationships that have built up through the years, where we're selling at spot, not a premium, not a discount, but spot. And we're finding that utilities understand that approach, and I think they welcome that not all, a lot of producers are locking up 100% of their sales commitments, of their production commitments under long-term supply commitments, which is great. That de-risks the asset, and that's a very stable cash flow coming in, but it also hedges the risk of the utility. It robs investors of 100% of the upside that we want to provide for them. So UEC has said we'll get into production at $60 a pound. We'll come out with some more clarity on that in the coming weeks, where we've been we've been de-risking the assets for some time, but we've accelerated the restart activities at Irigaray Christensen Ranch, where we have, obviously looking to restart mine units 7, 8, and 9 at Christensen Ranch, and basically completing the drill program this month in new modules in mine unit 10, and then also building out approval to spend the money to build out those modules, which means 2 additional header houses and the well field drilling. So, we basically have a situation where, we've said all along that the restart in Wyoming is less than 6 months. That's even lessened with the activities that we've taken over the past 6 months. So we're really now just wanting to see prices stabilize at 60 or better. But when we see that, if it's over a quarter of those prices, we're very rapidly restarting existing well fields, which shut in 2018 and are restarting with a minimal capital investment. We have the similar situation in Burke Hollow, not as advanced. We still have probably 30 million in capital to build out the iExchange columns in the satellite, but the production well fields, production area 1 and now production area 2, are being completed in terms of the monitor well rings and laying out the patterns for the first production areas. So again, we see Wyoming in less than 6 months, Texas probably less than 12 months from a restart decision, which is getting much closer given where uranium prices are today.
Very well, Scott. I appreciate the overview and a little bit of flavor on what UEC's up to and maybe some of those conditions to get going there on the ground again. Any other comments on UEC before we go?
No, it's exciting. I mean, to be involved with two companies that are as positioned as well as they are, one in a pure mining development focus in a stable jurisdiction. We believe that, North American uranium, really are valued in a dangerous geopolitical world, not just for North American consumers, but globally in the West. And URC, we're eager to be part of the production revitalization, not just in North America, but around the world. So it's really exciting times, and look for a lot of catalysts, both in the market and company-wise, coming down the road.
Well, Scott, let's leave it there for now. Just final to wrap up here for potential investors who are listening in, the company URC has a market capitalization of about 200 million US dollars. Why should Uranium Royalty Corp be considered within the institutional, family office, and retail investors portfolio?
Yeah, listen, I think if you're a uranium investor, you're probably wise to hold a portfolio of the leading companies. I think all the boats are going to lift in this environment we have going forward. But as investors, we should be seeking out the companies that outperform the pack. And I think the diversified nature of URC, almost an ETF in that regard, but very actively managed by the companies that we add to that portfolio, really has a good fit in what's going to be a uranium bull market like we've not perhaps seen ever since the dawn of the atomic age. So excited to have folks invested in URC and along for the ride.
Scott, and the best way for investors to reach out to the company?
uraniumroyalty.com is a website where you can get our full presentation and breakdown of the assets. We also have uranium royalty coverage at Canaccord, H.C. Wainwright, and Paradigm. Feel free to look at their more in-depth analysis and valuation, but certainly can reach out through the website to me or our IR staff.
Scott, always good to catch up. Keep up the work, and looking forward to chatting with you again soon. Thank you.
Great. Thank you, Andrew.